What if I told you that there is a completely legal way to pay absolutely zero taxes on your investment gains, and the IRS not only allows it, but actively encourages it? Not a loophole, not a gray area, not something only available to billionaires with expensive accountants. A straightforward, well-documented strategy that millions of Americans use every single year, and that most people have never heard of. In this video I'm going to show you exactly how to pay zero taxes on your investments, the accounts you need to open today, and the strategies that could save you tens of thousands of dollars over your lifetime. This might be the most valuable 12 minutes of financial education you've ever watched. Let's get into it. First, let's talk about why taxes matter so much in investing, because most people completely underestimate this. When you invest in a regular brokerage account and your investments grow, you owe taxes on those gains. Every time you sell a position, every dividend payment, every year, a portion of your returns goes to the government. Here's the brutal math. Let's say you invest $500 a month for 30 years and earn an average of 8% per year. In a taxable account, assuming a 20% capital gains tax rate, your ending balance would be approximately $680,000. The exact same investment in a tax-advantaged account, paying zero taxes on growth, gives you approximately $928,000. The difference $248,000, $250,000, lost not to bad investments, not to market crashes, but purely to taxes. That's why this matters. That's why every dollar you can shield from taxes is worth significantly more than a dollar you can't. So how do you do it? There are three main strategies. Strategy number 1, the Roth IRA. This is the single most powerful tax-free investment account available to ordinary Americans. Here's how it works. You contribute money that has already been taxed, your after-tax income. That money grows completely tax-free inside the account, and when you withdraw it in retirement, after age 59 and a half, you pay zero taxes on the gains. Zero, not reduced. Zero. Think about what that means. If you contribute $7,000 per year to a Roth IRA starting at age 25, and that money grows to $800,000 by retirement, you withdraw all $800,000 completely tax-free. The government gets nothing. The 2026 contribution limit is $7,000 per year, or $8,000 if you're over 50. You must have earned income to contribute, and there are income limits. Single filers can contribute up to $161,000 of income. Married filers up to $240,000. Where to open one? Fidelity, Vanguard, or Charles Schwab. All free, all excellent. Strategy number 2, the traditional IRA and 401k. These work differently from the Roth. Instead of paying taxes now and avoiding them later, you get a tax deduction today and pay taxes when you withdraw in retirement. If you're in a high tax bracket now and expect to be in a lower bracket in retirement, this can save you significant money. You reduce your taxable income today, potentially dropping into a lower tax bracket, and defer the tax bill to a future version of you who may pay less. The 401k limit in 2026 is $23,500 per year, or $31,000 if you're over 50. If your employer offers a match, free money added to your account, always contribute at least enough to get the full match. That is an instant 50% to 100% return on your money. Nothing else comes close. Strategy number 3, tax loss harvesting. This one works in your regular taxable brokerage account. No special account needed. Here's how it works. Imagine you have two investments. Investment A is up $10,000. Investment B is down $5,000. If you sell investment A, you owe capital gains tax on $10,000. But if you also sell investment B at a loss, you can use that $5,000 loss to offset $5,000 of your gains. Now you only owe tax on $5,000 instead of $10,000. You immediately reinvest the proceeds from investment B into a similar, but not identical, fund. Your portfolio stays basically the same, but you've cut your tax bill in half. Done strategically every year, tax loss harvesting can save thousands of dollars in taxes while keeping your investment strategy completely intact. And here's the bonus. If your losses exceed your gains in a given year, you can use up to $3,000 of excess losses to offset ordinary income, your salary, your freelance income, anything. Any remaining losses carry forward to future years. Now let's talk about the order in which you should use these accounts, because sequence matters enormously. Step 1. If your employer offers a 401k match, Contribute enough to get the full match. This is free money. Never leave it on the table. Step 2. Max out your Roth IRA. $7,000 per year. This is your most valuable tax-free growth vehicle. Prioritize it. Step 3. Go back and max out your 401k. Up to $23,500. More tax-deferred growth. Step 4. If you still have money to invest after maxing all tax-advantaged accounts, use a regular brokerage account. Apply tax loss harvesting annually. This sequence alone, followed consistently over a career, can mean the difference between retiring with $1 million and retiring with $1.5 million or more, from the exact same monthly contributions. Let me leave you with the most important takeaway from this video. The government has created these accounts specifically to encourage people to save for retirement. They are not loopholes. They are not tricks. They are tools. Powerful, legal, available to almost everyone, that the wealthy have been using for decades. The only question is whether you use them too. Open your Roth IRA today. Contribute whatever you can. Even $100 a month in a tax-free account, started today, is worth more than $200 a month in a taxable account started in 10 years. If this video showed you something valuable, please hit the like button. Subscribe for a new video every week where we show you exactly how to build wealth the smart way. And in the next video, how a $100 monthly investment could make you a millionaire. The math will surprise you. See you there.